You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble. His website is dollarcollapse.com. Welcome to the show, John.
Hey, Jim. Good to talk to you again.
Interesting headline on your webpage. We're all hedge funds now. What does that mean?
That means that the world has borrowed so much money, at least the developed world, that debt slows down economic growth, and governments have traditionally responded to that kind of thing with lower interest rates and deficit spending and all the rest. But now we've reached the point where we're pushing interest rates not just down to zero, but into negative territory. There's something like $2 trillion of bonds now trading in Europe with negative yields. In other words, you have to pay them to own their bonds. And so that presents some life-changing challenges for entities that need a positive yield. For instance, a retiree. If you retired on the assumption that the money you put away would yield you 6% in bank CDs, and now you're getting 0.5%, or maybe even negative 1% in some cases, you can't make ends meet without either dipping into principal or stopping being a retiree. In other words, going back to work. So that changes your life really dramatically. And you're seeing these behavior changes across the board out there where pension funds that need to generate 8%, a lot of which is supposed to come from fixed income, can't do that anymore. So they have to go way out on the risk spectrum and invest in junk bonds and equities and other kinds of exotic instruments that tend to be really volatile. In other words, they become hedge funds, investment companies that invest in risky stuff based on their perception that they can generate higher returns by doing that well. And so for a retiree to have to do that, to shift out of their bank CDs and into stocks, or a pension fund or an insurance company to shift out of traditionally safe government bonds and get into really aggressive stuff, that makes them hedge funds too. So we're converting the world of risk-averse investing into hedge funds. And that can only end really badly because this is basically dumb money. If you're a retiree, you don't know how to invest in growth stocks necessarily. And if you're a pension fund manager, there's no institutional memory in your company for investing in alternative investments that are risky and hard to figure out, and vastly more complex than a portfolio of government and corporate bonds. And so you're going to be likely to do it badly and to lose big in the next downturn. So that's the world we've created, where a lot of people who shouldn't be investing in risky stuff are jumping in with both feet without really understanding what it is they're doing or recognizing the risks inherent in it. And in the next correction, the next garden variety stock market downturn of, say, 20%, these guys are going to get creamed on money that they couldn't afford to lose in the first place. This is money that was supposed to be risk-free and to generate a small but positive return. Well, now they're putting it in stuff that might lose them 20 or 30% easily in the next downturn. And at the same time, most of these assets are priced for perfection. We've seen the stock market soar in recent years, and junk bonds are at record levels, and lots of other high-risk assets are at levels that in the past have preceded a major correction. So it's likely that we'll see this process kind of come to a head in the next couple of years, if not this year. And so we're creating the conditions in which there's going to be serious turmoil out there, and the people that are going to be hurt are exactly the people who don't deserve to be hurt. The ones who the governments of the world have forced into really risky investments, and who didn't set out to become hedge funds, but now see that they have no choice but to do this because of dysfunctional government policy. So it's really despicable what's happening. We're shifting wealth from regular people into the pockets of the 1%, the guys who can actually figure out this process and hire high-powered money managers to allow them to act like hedge funds, but to do so effectively rather than the guys who are getting into it without understanding what they're doing and who are going to get burned. So yeah, it's in so many ways, this is a terrible, terrible situation that we find ourselves in, and this is just one of them. But it's one of the really interesting ones that's happening right now.
Do you tell people there's nothing wrong with parking your stuff in cash until the dust settles?
Well, you can tell them that, but then they come back with, well, how am I supposed to eat? If I'm earning 0.5% on this cash that was supposed to earn me 6%, I can't do that. And I also hear from people who have equities, stock mutual funds, things like that are way up, but they don't know what to do with them either, because they know if they sell those things, there's nothing that they can earn a decent return on to put the proceeds into. If they put it in a money market fund, they get nothing. If they put it in the bank, they get maybe next to nothing or less than nothing. And remember, bank accounts are now not even safe anymore. It used to be a bank account was the same thing as cash. Well, that's not the case in a world of bail-ins, where the new policy is that if your bank gets in trouble, they dip into your account, and they take some money out of it in order to keep the bank from going bust. And so you not only don't earn anything on a bank account, but you might actually lose 5 or 10 or 20% when the bank gets into trouble and the government takes part of your account. And then Australia, meanwhile, is looking at taxing bank balances. So not only don't you earn anything, but the government directly takes money out of your bank balance year after year after year. And so your capital diminishes with time instead of growing or remaining stable. So, all of this presents people with some really unpalatable choices. And a lot of people feel like they have no choice but to find the income that they need somehow. And if that means buying equities, which go up and down, lately they've been going up, so it seems like not a bad idea, but most people don't get that you can lose 30% in a stock portfolio. Even though it's gone up for the last 3 years, that doesn't make it risk-free. That just means that the reversion to the mean, the risk is out there somewhere, and it's going to happen eventually, and probably the minute you jump in with both feet, because that's kind of how life works. When you finally can't stand it anymore and you go for the easy money by jumping into the thing that's been going up for the last few years without you, that's when it goes back down. And I'm afraid that's the case for a lot of small investors and other dumb money out there right now.
Well, isn't there a saying, by the time the general public realizes there's a trend, 90% of the value's already been taken out of it?
Yes, and then the smart money, the guys who got into it, who basically rode the early trend and maybe caused the trend, are the ones who will hand off their investments to you. They'll take your cash and give you the stocks that have gone way up. And that is emphatically happening right now. The rich people of the world are lightening up on equities. And they're taking the proceeds and they're buying Van Goghs and London penthouses and farmland around the world, and in that way they're protecting their capital by putting it into stuff that governments can't make more of, on the assumption that when things do turn down, the governments of the world are going to have no choice but to devalue their currencies really aggressively in order to prevent a 1930s style depression from spreading around the world. So in currency terms, if you own a Van Gogh and the currency goes down by a third, the dollar or yen or euro value of your Van Gogh goes up by a third. So you're protected, and that's historically the way it's worked. Now, one question in all this is why gold and silver aren't performing the same way as London penthouses and Van Goghs and, to an extent, farmland. Because normally that precious metals are part of that process. When money starts flowing out of currencies and into hard assets, gold and silver are among the main beneficiaries, and that hasn't happened this time around. So, the explanation could be several things going on. One is, active manipulation by governments around the world to keep gold and silver down, because these are competing forms of money, and when they go up, they make the euro and the yen and the dollar look bad. Or it could be just one of those flukes of markets where not all asset classes in a certain category move at the same time at the same rate, but then the one that's been left out catches up eventually. And I think that's also possibly the case for gold and silver, where the guys buying Van Goghs in London penthouses are looking around and saying, well, those things aren't cheap anymore. What else that will protect me from a global devaluation is cheap? And they're going to start focusing on precious metals at some point. You know, you're seeing China and Russia and India already do this. They are just snarfing up all the available gold and silver that's out there. And they're doing it probably on the assumption, well, first of all, they have a cultural history of using gold and silver as wedding gifts and wealth accumulation in the form of jewelry and stuff like that. But at the government level, especially in China and also in Russia, they're doing it because they see this coming. They don't want to own all of these dollars, which they have tons of right now, if the U.S. is going to have no choice but to devalue the dollar at some point in the not-too-distant future. So when that happens, they want to be in gold and silver, which will tend to go up in value, or at least hold its real value, versus these currencies that are being devalued. So let the attitude of China and Russia spread to the rest of the world's financial markets, and you'll see gold and silver just rocket from here.
What kind of moves will the U.S. government make to drive the currency down?
Probably the way it'll work is our economy will slow down, and that will spook, because the dollar is too strong. That makes selling stuff abroad harder, and it lowers corporate profits because our multinationals can't make as much money selling stuff on the global market if they have to price everything in really expensive dollars. So that, in turn, lower corporate profits will make the stock market start to go down, and that will spook U.S. policymakers because they understand that they've basically created a world of hedge funds out there. They understand that individual savers will be crushed by this, and they won't spend nearly as much money, and consumer spending will go down, and pension funds will find a big hole in their balance sheets. They'll be even more underfunded than before, and they will either have to ask for more contributions from their members, which is like a big tax, or they'll have to do other things that make the economy look weak and scare people, and this kind of thing can spread in an over-indebted economy. U.S. can't let that happen. So what we will do is come out with a new QE policy. We'll say, okay, we're going to lean against the current weakness by creating lots of new dollars and using them to buy back bonds and push down long-term interest rates and blah, blah, blah. The same thing that we've done in the past, and that didn't really work. But we'll do it on an even bigger scale because that's all we've got left. And the net effect of that will be to make the dollar less valuable. That'll be our ultimate goal, to devalue the dollar. And at that point, then the dollar will be going down versus things that tend to hold their value over time. In other words, London penthouses, when valued in dollars, will go up. Manhattan real estate will go up. That's what's happening right now, by the way. But then gold and silver will also go up because those are the things that haven't yet really rocketed in this process. And so there will be an arbitrage. You sell your London penthouse or one of your London penthouses, and you use the proceeds to buy a whole bunch of gold and silver. You store it in Hong Kong or someplace, and then you wait out the storm. And that's the process that will begin when the U.S. announces that it's not actually going to raise rates after all, and maybe it's going to cut rates, and maybe it's going to go to a new QE program. Now that's out there waiting to happen, and when it does, you got to figure gold and silver will be major beneficiaries of that.
We'll have more with John Rubino right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to John Rubino. His website is dollarcollapse.com. John, I understand the IMF is talking about including the Chinese currency in its basket of currencies, and you told me that will reveal a secret a lot of people have been wanting to know for quite some time. What's the secret that will be revealed?
Well, the secret is how much gold China actually owns now. And the process that's at work here is that, China is becoming a major global trading power. It's arguably the biggest trading country in the world now. It's right up there with Germany, ahead of the U.S., and its currency is being used more and more out there as, to an extent, reserves, but also to a bigger extent as a trading currency. You price things in yuan and use Chinese currency to buy and sell. And because of that, it makes a lot of sense for the IMF, which keeps a currency called special drawing rights, which is made up of a basket of other major national currencies. It makes sense for the IMF to include the Chinese yuan in that basket. And so that's inevitable, and it's finally going to happen, it looks like, by year end. And at that point, it makes sense for China to clarify its finances as a way of showing the world that its currency really is legit and really does belong to be in the belong in the special drawing rights basket. And one of the ways it'll do that is by announcing its gold reserves, an updated version of its gold reserves. And since they've been accumulating massive amounts of gold, according to statistics like gold imports from the Shanghai Metals Exchange, money flow or gold flowing into China via this exchange and not flowing back out, that gold is somewhere in China, and so if it's in official government reserves, they've got to raise their reserve number dramatically from the current 1,000 or so tons to something quite a bit higher, and we'll see what number it is. But if they actually come clean and announce an honest accounting of their reserves, it's going to be a very big number. It's going to be something comparable to, for instance, Germany's gold reserves. And that's going to show the world just how much gold China has been importing and how serious the world's second biggest economy is about accumulating gold. And so that can't be anything but positive for the gold market, because it's a huge vote of confidence on the part of the up-and-coming global power right now. And so when that happens, it'll be interesting to see the impact on gold pricing, because first of all, of course, it'll be, as I said, a vote of confidence, and it will also lead people to run the numbers and see that China alone has been buying up pretty close to what the world's gold mines produce. And then India has been buying a lot. Russia has been buying a lot. And together they've been buying more than the world's gold mines have been producing. So the question then will be, where did the extra gold come from? The conclusion to that can only be Western central banks. That's the only place with enough gold, the only sources of enough gold to satisfy this demand. And so then the question is, how much longer can the Western central banks continue to ship their gold to Asia? And the answer to that will be probably not a whole lot longer. It doesn't make sense for them to run down their gold reserves to zero. And so at some point, they hit a wall and have to stop exporting gold. And at that point, demand will outstrip supply, and the only way to bring that back into balance is a rising price. So there's a chain of logic here that leads to higher gold and silver prices, and it could be kicked off by China revising its gold reserves as part of its entry into the IMF basket of special drawing rights. So we'll see, but it's an interesting thing to keep track of, and it's hard to see it as anything other than positive for gold and silver prices.
John, anything else you wanted to throw in?
Well, lots of interesting stuff going on out there in the currency world. The Greek negotiations in Europe are coming to a head right now, and it's not pretty at the moment. Greece just can't seem to come up with a set of reforms that satisfy the European lenders who are needed to keep funding Greece's big deficits. And if they can't come to some kind of an agreement, then Greece either has to default, or they have to find another source of funds like Russia, or who knows, or Germany just has to bite the bullet and buy Greece out, basically. Just take their debt onto the German balance sheet and keep Greece in the Eurozone, but at the cost of assuming their debts. None of this stuff is attractive to the Europeans. And so something has to happen, because you can't go on as it is, because Greece is going to run out of money. So some kind of a resolution has to happen here. None of them are attractive. None of them are the kind of things that the financial markets of the world want to see. So that's another story for the next couple of weeks, and it's not clear how this plays out at all, because the numbers don't allow a happy resolution. Greek unemployment for young people is 50%. They can't go on like this. That's a recipe for a revolution. They've already voted in a radical left party that is largely anti-Euro, and what else can they do from there? Vote in the neo-Nazis? Who knows? Communists? It's not clear. But if this didn't work, the next thing will probably be even more radical. So something has to happen, and almost anything that happens is negative from the point of view of the global financial markets, because it involves huge amounts of debts being taken on by one country or another, or a default on the part of a Eurozone country, and all the debt that used to be denominated in euros being switched to drachmas, or a European country being bought out by Russia and moving east instead of west, or west instead of east. So it's not clear how this plays out, but it's definitely something to watch, because just about any outcome carries a lot of risks with it. Meanwhile, the Middle East, crazy stuff going on over there now. You've got the U.S. Working with Iran in one theater and actively working against Iran in another theater. So we basically don't know what we're doing over there. Sometimes we're friends with people, and sometimes we're bitter enemies, and sometimes it's at the same time, And so I'm sitting down today and writing something about the incoherence of U.S. foreign policy, and what's going on right there in Iraq and Yemen and Saudi Arabia. It illustrates our incoherence. How we don't really know what's going on over there, yet we feel like we should be involved, and we've got the military hardware to do it. So by God, we're just going to go over there, and we're going to blunder around until everybody that we don't like is dead. And that's kind of late stage empire behavior. The Roman Empire did a lot of stuff like that. Just before it started to hyperinflate, and which was not too long before the barbarians ended up overrunning them. We're behaving kind of the same way. We're making enemies around the world, spending all our money, and getting basically nothing for it. So that's yet another thing that bears watching in the short run, because we've got soldiers over there right now. We're bombing people, and we're supporting people who are bombing people, and meanwhile we're threatening Iran if they don't stop their nuclear program, and they're promising to stop it, but really secretly going on with it. And we know that, and they know that, and everybody knows that. And so how it resolves is, again, pretty unclear, because there aren't any really good resolutions that you can point to in the short run that will satisfy all the major parties that have to be satisfied. So that's another thing that's just going to be percolating along until it blows up. And we don't know when it'll blow up, but there's a pretty fair bet that the Middle East burns in the not-too-distant future, largely because of our own incompetence here in the U.S.
John, great talking to you.
Thanks, Jim. Same here.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. His website is dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net, and check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.